wisdom that you would share with listeners for how you think about interest rates, prioritizing debt? That's a question that we get, constantly.
Welcome. I'm Rose Price, a partner in CFP here at VLP Financial Advisors. And Chris?
I'm Chris Mellone, partner and financial planner here at VLP.
So something new. We're going to kick off a new series called the Retirement Readiness Journey. So something that we're going to cover over several podcasts and really kind of outlining really what we do with clients in preparing them for retirement.
Yeah, I would say probably in my experience, about half the new meetings that I've had, especially in 2025, are potential clients in this window. Hey, you know what? Past the midpoint in my career, I see what's on the horizon. 10 to 15 years away from retirement. Where do I start? I think it's natural that we really dive into this segment. I'm looking forward to it.
Yeah, so it's really going to be talking about the journey, right, and the path and kind of the process that we go through with clients as they embark on, hey, I'm ready to really kind of think about what the future looks like, what's life after working, and how's that going to work, and what do I need to do to prepare?
Yeah, and the way that we're envisioning this is to start really in that 10-year time window. A decade, nice round number. We'll scale into 5 years, and then ultimately around the corner, 12 months, and go from there.
Yeah, so we're really looking forward to it, kind of going through the whole journey and how that works. And one of the other things is, I think it's going to be great, is we're also going to have some of the pieces that we use with clients to talk about, what are the things you need to consider. So there'll be opportunities to go to our website. You can use the link below for resources. And also, if you're kind of on the fence and saying, hey, is this time to pull the trigger? What I need to do? You can also get a complimentary consultation.
For sure. Great. Well, when we think about what we do in a nutshell, really not only in the lens of retirement, but really any planning, we always start with, hey, before we determine how you're going to get to where you want to go, we got to start with where you are. And we're going to talk a little bit about today the data and just our thought process and give some experiences on that based on what we've seen with clients.
Yeah, because really where we want to start is, what is your current financial health? If you just like going to the doctor, that's kind of what we call the financial doctor, kind of an analogy you could use there, is where's your baseline? What does that picture look like? How do you where are you as far as your savings, your net worth, your cash flow, to really set the basis so we can understand what are some of the things we need to adjust or consider as we go through this journey to get you where you want to go.
Yeah, and it's so interesting when you kind of go on this journey with a potential client, because we see so many different approaches to this. We obviously have the type A client. They already know where everything is and they have their spreadsheets and whatnot. And then we have really successful potential clients that come in. Their stuff is everywhere. It's disorganized. So there is no one size fits all sort of way to go about it. So I think some of the stories that we share will be fun to walk through.
Yeah, I mean, it's really interesting kind of what you see when you pull back the cover and say, oh, well, everybody, as you alluded to, they'll be like, oh, I have this, and this. This is what my cash flow is. This is where every dollar goes. And then you have someone who sits across and go, I've had 6 jobs. I'm not sure where my last 401k is. And you're kind of like, all right, well, let's get started.
Yeah.
So,
yeah.
Each journey is different. And the great part is we get to meet clients where they are and help them figure out how their journey is going to be. And like I said, there's no one size fits all. So pretty exciting. So let's start with kind of when we're starting to work with a client to assess their current financial health. Really, the first part we're looking at is calculating their net worth.
Yeah, and that's something that's very simple. Something that, we say, well, what do you have? Like, when we're talking about assets, what do you have in your savings account? Just stuff that's at your local bank, and that kind of looks different for everybody, that number that they like to keep in there. Where are your investments? Do you even have an investment account?
Yeah.
Is it just your 401k and some of your other retirement savings account? Do you own your home? Do you rent? We sort of go through all of those different benchmarks that we check. And I think when we think about the organization of this, we tend to see different things. It's either, hey, I'm a lifer, I've been in one company for 30 years,
yep,
or different locations. And then there's obviously a little bit more legwork for us to actually wrap our arms around this.
Yeah, and it's also not only that, do they have multiple properties? Do you have a rental home? How does that work? Do you have a beach house, a lake house, whatever that would look like? And also personal property. From time to time, we have clients who come in who maybe are collectors, or they have some asset that is highly valued, and we're trying to consider, I have a client who's a big collector of sports memorabilia, and we're like, how do you value that? What's that look like? especially when you have a spouse who's not and going, well, what happens to this collection if you're no longer here? So it's really, those things are harder to nail down. So we, tend to have to kind of do a little bit more legwork and to consider what does that really mean for the longevity of their plan.
Right. And then, of course, there's the scenarios where we'll work with clients that do own businesses.
Yep.
And that's something where we have experience in working with valuations and some of the dynamics around succession planning. And that's sort of a natural conversation. But we obviously would put a placeholder for that sort of value. I also think that this is a really telling piece of the equation for asset location.
Yep.
And how much a potential client has in cash in a non-retirement investment account versus all of their assets being in a retirement account or TSP or something similar.
Yeah, because that really kind of, when you have all your assets in just retirement accounts, whether that's your 401k, your TSP, your IRA, that the tax picture becomes a little bit more complicated. Mm-hmm. And planning for retirement kind of limits some of your opportunities because you're going to have an asset that's going to generate income for a living, and you have to think about what are there things that we need to shift and adjust to build up other assets so that we're not dependent on every dollar that comes out is ordinary income. But yeah, that's something that, once again, if you're starting this process 10 years out before that retirement date, you have some ability to adjust and pivot to say, okay, I've been putting all my money over here. Maybe I need to think about, do I need to do Roth? Maybe I need to start putting money over here in this individual investment account or trust or whatever that looks like to really help that long-term longevity picture look different. So we talked about assets. Really when we're talking about calculating net worth, we have to get to the liability side. And this can be all over the place. Really what we're talking about is what's your outstanding debt? Do you have a mortgage on your property? Do you have student loan debt that we need to consider and think about, or student loan debt for yourself, your children? Loans, do you have a car? Any other type of loan, maybe a personal loan for you've done something that you've helped out, and credit cards. So all those pieces come into the play to say, okay, we're looking at, here's your asset list, here's all the things you own, here's your investment accounts, if you have them, your savings. And on the other side, we got to say, what do we got to subtract? Like if we're looking at your net worth, how does that debt picture look at? And this also gives us kind of an idea of potentially what are spending habits, and is there a concern that we really have to buckle down on the expenses and take a look at cash flow?
Yeah, and I think, with this group exclusively, hey, I have 10 years, this from time to time can be encouraging, or from time to time can be a wake-up call and say, hey, we really need to steer, make adjustments, and there's still a long enough runway to where you're not going to need all of this money at year 10. You're going to obviously live way through, onto retirement, but this gives us enough time to really course correct it if we need to.
Yeah, and also, a lot of times in this case, when we're starting out with clients in this scenario, they're coming through a scenario where kids are in college now or coming off the payroll, or we're hoping they're coming off the payroll. Yeah. And so they are now going to have more disposable income, and we can say, okay, you're spending X, now we need to take this, and this has to be redistributed. We have to think about where we're going to position that cash going forward. We see a lot of that, especially when you're about 10, 15 years out. Typically the kids are starting to, if you have children, they're starting to come off the payroll. Your expenses are going down, and it gives you a natural opportunity to say, instead of just taking that money and letting life creep and doing other things, we're going to be strategic about it.
Right. Keep living the way that you're living, and essentially shift where some of that cash flow is going. So I'd be interested to get your perspective on the reactions that you've seen from clients over the years, where we walk through this exercise. Here's all your assets. Here's your liabilities. Here's your net worth. What experiences have you had around that number?
It's been all over the place because, I always, we have conversations a lot, and, here we do a lot of training and education with our associate advisors and our interns. And, sometimes you have a client who come in and this is a really tough situation. And, our job is not always just to give good news. Our job is to give, put things in perspective and really talk about where reality is. It's been surprising. I've had scenarios where clients will come in and they are way better off than they considered. Mm-hmm. And a lot of this can be as a result of their upbringing and what they know. If they had parents who came out of the Great Depression, they're typically really frugal and think never going to have enough. Right. Versus you have people who are going, well, I've had scenarios where I had clients come in with $100,000 in credit card debt. Mm-hmm. And a long list of things, and thinking that they're in a great spot. And we're going, okay, you're paying 17% on this. This is crazy. Yeah. And you're driving the latest cars. We really have to talk about what is some, you're going to have to make some painful decisions
Yep.
if you're going to want to retire someday. So, I've seen it all across the board. How about you?
I'd say similar, where we have the type A clients where, hey, we go through all these things. Here's what you're worth. And then I ask for their reaction, and they'll say, hey, I know that, I'm tracking that. That's roughly in line with what I thought. And then the same kind of thing where, oh, I didn't know that. It's either better or worse, somewhere in between. I also think it's interesting to ask them if they have any sort of association with that number, as in, hey, I'd like that to be X, or I'm not going to feel comfortable until it's Y. If there's some sort of psychological tie, maybe that helps as a benchmark, but it's just good to know, because the last thing that we want is somebody to have that and then us not address it and talk about it.
Yeah, that happens a lot. We talk about, what do you want your net worth to be? Or especially when you do the planning and you start to say, oh, this is what it could be at age 60 or 65. Yeah. And then now it becomes a psychological benchmark they've got to hit.
Right.
And then when they hit it, they go, oh, now we got to let's move the goalpost. Yeah. I've had that happen lots of times. Yeah. But yeah, I just think it's really interesting to talk about how that's going to work over time. Just yesterday, this week, I was doing a meeting with a client who's been a client for 15 years, and they're in great shape. Matter of fact, we were talking about giving away money to their children, because they're never going to spend all this money, which is a great position to be in. But for fun, I was like, let's go back to your first financial plan we did 15 years ago and where we thought you would be. And they literally had double of the assets that the plan predicted they would have, which was really interesting. But it was a really cool exercise, because we went back to all the things we thought, that they needed to do, and some adjustments, they had to make. What was really interesting is how it all fell into place. Part of it was the investments had done better than we anticipated. Mm-hmm. They had some job changes and earned more. But it was really fun to kind of look back at that journey and say, okay, here you were. 15 years ago, you had $1.4 million you're thinking about, and now your net worth is 10 times that, and you're never going to spend all this money. So really an interesting kind of insight. And psychologically, they had this number in their head, and we've blown past it.
That's great. And this is also the part of the conversation where we typically have somebody come forward and say, oh, I read you need to have X to retire, or it's, I need to have this to retire. And that's obviously where we come in with more experience, more context, and say that's all in a vacuum. There's obviously more to it as we go through planning, that it's truly different for everybody. Yeah,
and that used to be the old commercial, people carrying their number around. But to your point, the number one thing I tell clients when they have that scenario is going, look, you don't know what their spending is. We have to look at your spending. Yep. And your spending is going to dictate what that number needs to be, and what your expectations are for your retirement. Yep. So we talked a little about net worth. I think the big thing is, as we talk about, positive versus negative net worth, it has indications, right? If you have a positive net worth, you're likely, and it may not be the number you want, but at least we're moving in the right direction. And how we're going to build that negative net worth? It's not. I had a negative net worth when you come out of college and you have student loan debt, and that's all you have, and not a house. Well, you have a negative net worth. But the reality is, it's a starting point. So we have to figure out, how does that impact the future, and what can you do to make those adjustments? So I tell clients, don't get discouraged. The best part is starting this journey to say, what is it? Understanding why the number is what it is. And then that leads into the opportunities to improve it.
Yeah. And I think in that same moment, sharing that experience that you just had, here's what we've seen over the years, that's obviously positive reinforcement. But if you don't have a benchmark, if you don't have a starting point, you can't even start talking about your goals and all the other sort of non-numbers related pieces of the equation, which we'll get to.
Yep. And also, that also gives you the opportunity to say, okay, what's your credit score? What's behind the curtains on the cash flow? How are we doing things? What we need to improve? Because net worth is all going to be a function of building more assets and controlling your liabilities. Right. And whether you're paying those down, taking less, or if you're taking smart liabilities. Having a mortgage is a smart liability. You need somewhere to live. It gives you other opportunities to do other things. But again, it's making sure that we're taking into account what is the pieces that are going to move that needle for you.
Yep. And I also think that it's interesting over the years to see sort of the connection or disconnect between how somebody feels in the day-to-day or month-to-month sort of routine of work and living expenses, and then how that translates into their net worth, or what they're actually saying and what they think it should be worth. I've had both scenarios. I've had both scenarios where they're like, oh, I feel like I'm living paycheck to paycheck, and they sort of have that pessimistic view on their cash flow, but their net worth is higher. And then I've also had scenarios where you're meeting with somebody and they're like, oh yeah, we're doing great. We're saving a bunch of money and I know that we're doing the right things. And then we'll look at their net worth and we're like, you're not.
Right.
There's some sort of disconnect there. So that's an interesting part of the equation.
It's like the diet theory, right? That they went on a diet for a little while but then the cookies called. So they're like, well, I was saving really good, but I just bought this new car. And we're like, well, wait a minute.
Just always the one-offs.
It's
like, oh, I just had to, something popped up.
And I think that's really where we come in, right? Like it's having that sounding board and having that point of reference to say, yes, you were doing great, but you just, you took this side step. Like we've got to recalibrate. We've got to think about how it's going to change. Because again, it's a journey. That's why we kind of named this whole podcast the Retirement Readiness Journey. And it's not always going to be a straight line. You're going to wind up the mountain. Just because sometimes you're going to be going sideways, maybe down a little bit before you go back up. But the reality is how, having that plan, having that ability to kind of analyze where you are, where you came from, and hopefully, keep an eye on where you're going. So let's talk about how do you increase your net worth?
So I think, there's two sides of the ledger here. Obviously, how do you save more? How do you pay down more debt? I think it'd be interesting for us to tackle your thoughts on how do you actually pay down more debt? Like, is there any sort of, wisdom that you would share with listeners for how you think about interest rates, prioritizing debt? That's a question that we get, constantly. Yeah.
And I think, first of all, first step is you got to line up what all your debt is. What the dollar amounts are, and then what's the interest rate you're paying. Mortgages are usually going to be at the bottom. And if you got a mortgage back in the opportunity when you had 2 to 3% mortgages, even greater. But again, if you have credit card debt, you have student loan debt, these are typically going to have higher interest rates than a mortgage. I mean, you can have a credit card with a 17% interest rate. We got to prioritize that because if you just pay the minimum, you're never going to pay that off. But if we're taking and being smart about, okay, we're going to pay this off, then we're going to move to the next highest credit, and then we're going to move to the next one. Once you get down to maybe it's just the mortgage, then we can pivot, right? We can shift and say, now we've paid down this debt, we've got this debt, but this is good debt. There's good and bad debt. And now we could take those funds that we were utilizing, and we're going to use them over here to start increasing our net worth by putting in investments, maybe more in our retirement accounts, or just starting in an individual account. So I think that, and again, it's prioritizing that high debt and then controlling any additional debt you're taking on.
Great. And I think, with that process, when you're paying down the higher interest debt and controlling, not taking on new debt, just seeing that number psychologically go down, that makes, such a difference. Even over a 6-month time frame, it makes a big difference. Yeah,
I've seen where, we've seen it, as you've talked about with clients, they come in and they've been paying down the mortgage or they've been paying down this. And I was like, wait, let's tackle this credit card debt and maybe we're going to pay an extra $1,000 a month. And then all of a sudden they're like, oh my God, I don't have any credit card debt. And then they can move to the next position. And then they're like, oh, wait a minute, now I have an extra $800 a month. But it's key to grab that $800 and put it somewhere else where we can systematically, help them get off to the right foot and meet that long-term goal.
Sure. And let's talk, about actually increasing savings. This is something where we've shared some, some examples over time on the Live Greater Review. Let's talk about how you actually have that conversation with clients about setting the goals of saving and some of the pieces associated with that.
Yeah, when you're setting the goal of saving, you got to start breaking down, once again, what's free cash flow? What do you have? We know what we need to live. You need to have some money for discretionary because life, you got to have a little fun. You got to have some cookies every once in a while. Otherwise, you'll be out there doing something that you don't want to do. But also, I really think it's important to get it systematically set up, because it's kind of like your 401k. I use this analogy all the time when when we do meetings with 401k clients and educating them is, the difference between why the 401k works so well is the money goes in before you get a chance to touch it, right? It's not like it comes to you and you have to take it down to the bank. Payroll does it for you, so it automatically goes in there. So there's no opportunity where I'm like, I got $1,000. Do I put $200 in my 401k or my savings? Or do I go buy cookies, whatever it is? That systematic, it's out of sight, out of mind, right? And next thing you know, it becomes a real number over here. kind of the same thing, if you're even outside your 401k, like what can you control? So if you want to do that individual investment account, you get paid in the 15th, that goes in the 16th, right?
Yep.
Get it in there before you have to make a sell, before you have to make that move. I think that's been huge. Probably the clients that have done the best and that we've seen their net worth go up faster and be able to meet their goals faster. It's all about setting up that systematic and sticking to it. And then on top of that, when you get pay increases, which we'll talk a little bit about, you can highlight on that, is making sure we're carving out additional funds.
Yeah, and that's something where you're just capitalizing on the momentum.
Yep.
It's like, hey, my lifestyle is in a certain place. Obviously over time you're going to have, months that are more expensive, less expensive, but the trend line is still there. Whenever you get an increase in your salary, that's going to be the first, place that we'd say, hey, take that money and just automatically reroute it. That way you won't even notice. If you do that, especially earlier on in your career or even, 10 years
Yep.
away from retirement, you're going to notice a very substantial difference.
Yep.
Something that I wanted to talk about also is for clients that are already maxing out their retirement savings accounts, even in this group where they're meeting the catch-up, limit and all of that stuff. Can we talk about actually setting a goal of the number that clients need to hit in non-retirement accounts to actually be able to have a little bit more flexibility around retirement?
Yeah, and again, this is going to go all back to understanding your income and your expenses, right? So if you're, we really like to build that piece up because it makes a fundamentally different tax picture. It gives you more options. Maybe you want to do Roth conversions later. It gives you the opportunity to do Roth conversions. Without it, it's pretty hard. And it also, it'll creep into giving you flexibility in Medicare and other things that you want to do down the road. So for us, a lot of times when we're meeting clients at this stage, that 10, 15 years out, we're really honing in on how much do you have in assets outside of your 401k. And it's all over the board, right? If you've been busy raising a family, you've been maxing out your 401k, you may not have much over here. And then that's where we want to kind of shift and say, okay, well, what can we start putting over here? Or maybe we need to rethink about how we're putting money into the 401k, and some of that has to be Roth and those types of things, because it really does allow you, when things pop up, whether it's an emergency or something happens where you have to replace something at the house or something with the family, you have ability. There's different choices you can make. When it's all inside a qualified account, your choices are pretty limited.
Right. Your hands are tied.
Yep.
Great. That's helpful. So let's shift gears to talking about how this sort of structure looks for tracking, all of your expenses and sort of cash flow, what you've seen over the years, what's worked, what hasn't worked for clients, some commonalities there. I think that would be interesting to talk about.
That's probably the one thing. Most people come and have no idea what their expenses are. And I think that has changed so much over the years. And the whole reason is because everything is either digital or on a credit card. A lot of people are walking around with cash anymore, right? Yeah. If you walked out with $200 and you went home with $150, you know exactly what you spent that day. When now you walk around, like my daughter's a perfect example. I had a caller the other day, and be like, you only have like $200 in your checking account. DoorDash is not your friend. Yeah. Because it's just a card. As long as it keeps working, people don't really estimate. But so that's one of usually the first steps where we're really trying to wrap our arms around what cash flow looks like and expenses. Is we need to start tracking where you're spending money. And I've seen all kinds of things. One of my favorite stories is a couple who came in, we're doing a plan, and I had a call. I literally had their 6 months of their credit card expenses because they put everything on their credit card and they really didn't want to fill out the form. This is, we see that a lot. I'm like, just send me that. So I put this in a spreadsheet. I had to go back and I think I had someone else double check it. They were spending like $3,000 a month on eating out. There was 2 of them. So I was like, hey, we're doing the plan. I'm like, what's going on here?
And this was before DoorDash?
It was before DoorDash. This was going out and they're going, well, the kids are in college and our refrigerator broke. And then we just downsized to a small college fridge. Mm-hmm. I'm like, excuse me? And they're like, so, now we just eat out because it's easier. But then we eat out than a bottle of wine. $3,000 on average. Some months were higher. They're like, well, I guess maybe we should just buy a new fridge. I'm like, you could have bought 4 refrigerators. You could have bought 1, 2 every month. Like it was just,
It's wild.
So it's funny how things can get out of control. And again, it was all because everything went in the credit card.
Yeah.
So for clients where, we have again, it's really trying to understand what they're spending and how, and what's a one-off, right? This wasn't a one-off. This was a trend for 6 months of spending a lot of money eating out. Starbucks, another one, like it's those little things where we get custom and easy. It's easy to hit Starbucks on our way to work. We do our mobile, and really being like, hey, and I always, whenever I have that scenario, I'll go like, hey, how much do you think you spend on X? And they give their number, and I'm like, okay, what do you think? And then, it's kind of like a fun game. And then I'm like, all right, now let's see what you really spend. But there's tools, I think tools are getting better. There's a lot of apps you can use that you can link your bank account, link your credit card, so you can start understanding. What I thought was really interesting, I used to do this a long time ago, is I would set limits of what was fair that I wanted to spend that week. So if eating out was, we were going to spend $150, what we're going to spend on groceries, what we're going to spend on entertainment. I used to get my alerts on Friday, so it was kind of like the family joke, and I'd be like, well, we're not going out to dinner. No pizza tonight.
Oops.
Like we've spent too much money. But I think the disadvantage of being a digital in the plastic era is we really don't understand where we spend money unless you really look at it. And this gives you that opportunity to really say, hey, where have I let things kind of creep up where I shouldn't have? And that immediately gives you the opportunity to say, okay, how can I correct it?
I would say my experiences are the same, where we'll see these sort of softwares, or we'll get a question from a client, hey, like this is the time where I'm really going to bunker down. And they'll look for a software, and they're really not out there as much anymore. A lot of banking, banks have actually bought them and brought that software in-house, and they'll start using it. But then ultimately, more often than not, they wind up in a spreadsheet or writing, it down. And I think, my opinion and preference would be that would be the best way for you to understand, what's coming in and what's going out.
And it's easy. In a lot of these, as you alluded to, the banks, you can export this stuff.
Yeah.
So it's easy to kind of do that, start that process.
Yep.
But I think when we talk about, your net worth and what's the best way to start figuring out how you can make that move and really move the needle, it starts with the cash flow.
Yep. For sure.
Yeah.
Well, that was a lot of fun. So we tackled, assets, liabilities, net worth, shared some good stories around that, moved to cash flow. This is obviously the foundation of everything, that we do, especially at this phase for 10 years away from retirement.
Yep, absolutely. I mean, that's where starting there allows us to start to see what are we working with, where are opportunities to improve that, and then figure out what's the plan forward to get you from where you are now to that retirement date. Great.
Well, Rose, thank you. And thank you to our listeners for tuning in to the first episode of the Retirement Readiness Journey. Looking forward to unpacking this further as we sort of scale into what getting closer to retirement looks like, and looking forward to sharing more stories. So thank you.
Yep, absolutely. Thanks for joining us.
Thank you for listening to this episode of the Retirement Readiness Journey. If you like what you heard, please subscribe to our podcast and share our podcast with family and friends who are ready to start planning for their retirement. Book your complimentary consultation now at vlpfa.com. And now for our necessary disclosures. Securities offered through Cetera Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors, LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for informational purposes only and are not necessarily those of Cetera Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Neither Cetera Wealth Services, LLC, nor any of its representatives may give legal or tax advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. The views stated in this podcast are not necessarily the opinion of Cetera Wealth Services, LLC, and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned. Due to the volatility within markets mentioned, opinions are subject to change without notice. Information is based on sources believed to be reliable. However, their accuracy or completeness cannot be guaranteed. Past performance does not guarantee future results.